if you're speaking about change in the interest rate environment, I don't know, I find it very interesting that we see the chief investment officer for Morgan Stanley shift from a 60-40 allocation to a 20-20, 60% stock, 20% bond, 20% precious metals. Michael Hartnett, the chief investment officer for one of the investment, or I think he's chief, for Bank of America, just came out with a 25-25-25-25% strategy. Again, you're seeing big money advisors, money managers, or investment officers reallocate their clients' portfolios away from a 40% allocation to U.S. Treasuries. They are pivoting into what would have been unimaginable. As Rick has often said, and I borrowed that statement from him for so long, 0.5% from Joe and Jane Sixpack to the Harvard Endowment Fund. And I caught the last part before I jumped on here where the Harvard Endowment Fund actually did buy some gold and silver. But we're getting to see, I think, the money managers or the investment officers from these large institutions pivot the way that the central banks seem to have been doing now for at least a year or two, where they have been shedding U.S. Treasuries in favor of gold, which not only has outperformed the U.S. Treasury market, in fact, it's doubled the performance of the 10-year Treasury over the last 25 years. But look at last year, where gold was up north of 40% and the U.S. Treasury 4.5%, or this year, where you have the U.S. Treasury three-quarters of the way through the year, call it up 3%, yet the dollar's down 11 and gold is up nearly 50. So we are witnessing a pivot away from traditional forms of investment, traditional ideology, into something that we have been talking about that was fringe. And you never heard money managers talk about anything greater than a 5% allocation to precious metals. Now, we always knew that was underweighted, certainly, but to see the CIO from some of the biggest commercial banks on the planet start to do this tells you that we are moving towards some form of a new understanding, appreciation, or integration of gold and silver into people's portfolios. And quite frankly, if they would have been listening to guys like Alistair or Rick a long time ago, these moves would have been made years ago when there was still a tremendous amount of upside to be made. Now, not to say there isn't now, but how much of the move has been missed, I guess only time will tell. Actually, I don't think that it's been too much in comparison to where I think it is going. But I think the most important thing to take away from this is that you're seeing some of the biggest and influential institutions here in the United States rethink their investment ideology. It's an interesting time, and I hope the general public catches on before it's too late, because I can tell you on the retail side of things, we've seen very sophisticated big money jump in with both feet over the last month or so. Business has been extraordinary. It hasn't been what it was like in 2021, January, February, silver squeeze, where we were getting 500 orders a day. Now we're getting more like maybe 100 or 150, but the size is much greater. The understanding is much greater. The mainstream, they haven't really woken up yet, but there is a subset of people probably listening to Rick and Alistair and you, Dunnigan, who are waking up. And hopefully it's not too late for the rest of the public. Certainly, I think this is a change that is long overdue and one that I welcome very much. Well, I think the biggest indictment against the system is, well, there are a couple. Number one would be the cross-border payment system, the renminbi cross-border payment system that was the M-Bridge. And this system, which is operational, has already been connected to 11 countries in Southeast Asia, which in and of themselves have twice the population of the United States, about 800 million people, and they also have taken over as China's largest trading partner by far. They represent almost 40% of global GDP. They've also connected several Middle Eastern countries, 5 or 6 of them, into this system. And I think when you take a look at the moves that they are making, it is the development of multi-jurisdictional vaults throughout what ultimately, I believe, will be the Belt Road Initiative. The first vault is completed in Hong Kong. The Shanghai Metals Exchange is expanding their reach. The first one is done in Hong Kong. And what it means now is that digital yuan is immediately convertible into gold in the Shanghai Exchange in Hong Kong, if you'd like, for delivery without having to convert first back to US dollars. Now, the second exchange, ironically, is being built in Saudi Arabia. Now, if you back to the genesis of the Bridge platform, Saudi Arabia was the fifth participant, full participant in Bridge. They are now building one inside of Saudi Arabia. Now, I listened to an interview with the gentleman who developed BRICS Pay, which is the cross-border payment system, B2B, business to business, retail, in essence, small bank to small bank, or business to the public. It's like a credit card, in essence, that will connect any of the folks who use the BRICS Pay system. Now, we have to understand that once maybe the biggest move in all of this, that a lot of the naysayers would say the BRICS aren't big enough, they're not substantial enough, and I understand people why they would say that. Independent of their size as is, which represents, I don't know, close to 50% of global GDP. But when Sergei Lavrov, the Russian foreign minister, came out and said, we're opening this up to everyone except the West, except the dollar, the pound, and the European Union, the bells went off, and they should for everyone. And so the gentleman who is setting up BRICS Pay, the developer, said, yes, we are in the process of right now rolling this along with BRICS Bridge, which is central bank to central bank. These are being opened up and rolled out through the Belt Road Initiative right now. That's 75% of human population. And then you throw in the other institutions like the Shanghai Cooperation Organization and the Eurasian Economic Union, along with the BRICS. These are all very closely tied entities. They're not all part of BRICS, but they will all be able to settle on this cross-border payment system that settles in 7 seconds, free from SWIFT interference at a 98% reduction in fees. But the kicker to it all is that, yes, they all would use their own cross-border payment central bank currencies, the digital currencies, that the majority of the countries in the world are already developing or have developed. The key is that they will be able to settle imbalances in gold, and ultimately, through a series of multi-jurisdictional vaults that started in Hong Kong, is now being built in Saudi Arabia, and then through the rest of the Belt Road, so that they can settle imbalances in gold or completely settle in gold. I think it is a trend that is growing with legitimacy by the day, and I think to underestimate it is a mistake.
You know, I've been watching the investment world for decades now, and I've got to say, what's happening today would have been unthinkable 10 years ago. When the chief investment officer of Morgan Stanley, one of the most conservative institutions on Wall Street, comes out and says, we're shifting our model from the traditional 60-40 to 60-20-20, meaning 20% of client portfolios going into precious metals. Folks, that's not a small thing. That's a fundamental rewrite of the playbook that's been followed by every pension fund, every financial advisor, and every so-called modern portfolio manager for half a century. Now, let me explain what that really means. The 60-40 portfolio, 60% stocks, 40% bonds, was gospel. It worked for decades because interest rates were falling, debt was cheap, and the system was stable. It was like the house odds in a casino. The banks always won, but that's all changed. The US government is now $35 trillion in debt, deficits are exploding, inflation isn't going away, and the bond market, which used to be the safe side of the trade, is now the risk. So when Morgan Stanley pivots to 60-20-20, and then Michael Hartnett over at Bank of America doubles down with his 25-25-25-25 strategy, it's not a fad, it's survival. He's saying 25% stocks, 25% bonds, 25% cash, and 25% gold. That's basically an admission that the safe assets of the past aren't safe anymore, and that gold, the asset Wall Street laughed at for decades, is now core capital again. Let that sink in. We're talking about the biggest financial institutions on earth acknowledging what guys like me, Rick Rule, and Alasdair Macleod have been saying for years, that gold isn't an outdated relic, it's the only real money left. And here's the crazy part. For decades, gold and silver were the assets that weird people talked about. You never heard a mainstream CIO say they were adding more than 5% in precious metals. If someone on CNBC even mentioned gold, it was usually in a joking tone like, oh, that's for doomsday preppers and pirates. But now the same institutions are talking about 20% or even 25% allocations. You know what that tells me? It tells me the smart money has finally realized that the foundation under the financial system is cracking. They're moving before the masses do. I caught part of a conversation before coming on here. It was about the Harvard endowment. And yes, even Harvard, that temple of fiat finance and academic orthodoxy, has quietly been buying gold and silver. Think about that. Harvard, whose economists have spent 50 years telling everyone that gold is a barbarous relic. Apparently, that relic is starting to look pretty useful again. And this shift isn't just a fad or some momentary fear trade. It's a reflection of what's been happening globally for years. Look at the central banks. For 2 straight years, they've been net buyers of gold at a level we haven't seen since records began. Over 1,000 tons bought last year. That's not random. That's a coordinated global move away from dependence on U.S. treasuries and the dollar. Why? Because the rest of the world has seen what happens when you weaponize the dollar. They saw what happened to Russia's reserves, $300 billion frozen overnight. They saw sanctions weaponized against entire economies. And they realized if it can happen to them, it can happen to us. So what did they do? They started dumping treasuries and buying gold, an asset that no one can freeze, that no one can print, that has no counterparty risk. This is what I call monetary Darwinism. The smartest species, or in this case, the smartest institutions, are adapting to survive in a changing environment. Now let's be clear. Gold has absolutely destroyed treasuries in performance over the long term. Over the last 25 years, gold has doubled the return of the 10-year treasury. And over the last 2 years, gold's up nearly 50%, while treasuries are barely breaking even. Meanwhile, the dollar's down 11% just this year. You don't need to be Warren Buffett to see the writing on the wall. And yet, for most of the public, this still hasn't clicked. The average person is still following the same 60-40 formula their financial advisor cooked up in 1987. They're still trusting the same Wall Street banks that got bailed out in 2008. And they're still being told that a little inflation is good for you.
I mean, the big money is waking up to it, no question. And when I say big money, I think there's a duty when you have that kind of money to think. And I'll tell you that, and I mean, I'm serious about this. Where do you put your money at a certain point is very difficult, right? You got interest rates that on the short term, the very short term interest rates, which are coming down. I think you'll see the opposite on the 10-year. Will move the other direction, just like it did before, just like we see in London, where they've lowered rates 7 or 8 times, and yet their 30-year treasury is pretty darn well near its all-time high. The bond market controls the back end, but I wouldn't buy the back end anyway. I would own some 6-month treasuries or shorter duration, and those are coming down. Where do you put your money when inflation, the real level of inflation, is far greater than the interest that you're receiving for something as safe and liquid as a treasury? What happens if Trump gets his way and they lower rates 200 basis points to 2%? And the CPI, which is at 3.1% right now, is actually higher than the rate that is stated. The big money won't stand for that. We know that the CPI, because you've had John Williams on this show, will tell you it's 11% right now. Add an 8 to it, the way it used to be measured before they changed it. Point of it is where do you put your money? Stocks at all-time highs, bonds at not quite all-time highs, but losing demand rapidly. So much so you create something called the Genius Act, which it is kind of diabolically genius, to create synthetic demand for U.S. treasuries because the organic demand is waning. Where do you put it? You put it in real estate at all-time highs. You put it in banks that are over-leveraged and undercapitalized, where you are now a unsecured general creditor with bail-in laws. So yeah, I mean, I think there will come a moment where the public at large realizes this, but the big money is asking these questions every day. What do I do with all this money? And no one would have ever thought that having that kind of wealth would be such a pain in the ass, such a difficult thing to safeguard. And as you get older, you're more concerned about protecting than you are making, because, you're thinking of your children and your grandchildren, and how do I pass it on appropriately. Interest rates spike in an environment where there's that black swan. Well, the banks are in trouble, the insurance companies are in trouble, the bond market's in trouble, the stock market's in trouble, real estate's in trouble. Where do you go? And I think people are realizing this. And, It's kind of a softball question for a guy that owns a precious metals company, but if people haven't figured out by now that I try and be as genuine as humanly possible, that I do as I say, they never will believe me. I will just simply say, to me, there are very few places where I think you can safely keep your money with a high degree of liquidity, where the biggest money in the world is showing you through their actions where they're going. And I think you will see that public catch on. But typically, the big money, well, they do this in the cover of darkness, where you got guys like, Jim Cramer, moron, saying, it's too speculative, it's frothy. They're not looking at this the right way, and they're not really part of it. But there are a lot of people who are clued in and understand where we're going and what's happening, that are buying gold and silver as a life raft. And that's the way that I look at it, but not just for an emergency, right? It's for an opportunity as well. And maybe having that dry powder in the form of something that is keeping its purchasing power against a dollar that's down 11% this year and gold up over 40, it's keeping its purchase. You go back as far as you want, and I can make this analogy in real estate and in anything.
And let's not kid ourselves. This isn't some backroom theory or internet rumor anymore. It's happening, it's functional, and it's growing faster than anyone in the mainstream financial world is willing to admit. The mBridge and BRICS pay systems are connecting countries that collectively represent 3/4 of humanity. That's not an exaggeration. 75% of the global population now lives in countries that are either directly using, testing, or preparing to use these non-dollar payment systems. Now imagine this. You're an energy exporter in Saudi Arabia. For 50 years, every barrel of oil you sold had to be priced and settled in US dollars. That's the backbone of the petrodollar system, but now you can sell oil to China, get paid in yuan, and immediately convert that yuan into gold in Hong Kong or Riyadh. No need to touch the dollar, no need to go through New York, and no need to worry about sanctions. That's what I mean when I say the monetary world is splitting in two. One half still clinging to the dollar system, the other quietly building a gold-backed alternative. And here's the kicker. This new system is faster, cheaper, and in many ways more honest. It settles in seconds, not days. It costs a fraction of the SWIFT system. And most importantly, it doesn't require trust in a government that's $35 trillion in debt and debasing its currency by the minute. Now, I'm not saying the dollar disappears tomorrow. Far from it. The dollar's not going to vanish, it's going to degrade. It's going to fade, not explode. It'll still exist, just like the British pound still exists. But its role as the global reserve currency will erode, bit by bit, until one day it's just another regional currency, like the euro or the yen. That's the endgame here, and the process is already well underway. When people say, "Andy, you're exaggerating, the dollar's strong," I tell them, yeah, the dollar's strong the same way a candle is bright right before it burns out. It's relative strength, not absolute. The dollar's only strong compared to other paper currencies that are also being debased. But against gold, against real money, it's collapsing. Gold's up nearly 50% this year against the dollar. It's up across every G7 currency. That's not a coincidence. That's a signal. And yet I still hear folks on CNBC saying, well, gold's going up, but inflation's coming down, so it doesn't make sense. Really, it makes perfect sense if you understand what's actually happening. Gold isn't going up because of inflation. Gold is going up because trust is going down. That's the real story. Trust in the banking system, trust in the treasury market, trust in fiat itself, all of it's eroding. And once trust starts to evaporate, you can't rebuild it with interest rate tweaks or press conferences. You need credibility, and credibility is something that no central bank can print. That's why central banks themselves, the very institutions that create fiat, are the largest buyers of gold. It's almost poetic, isn't it? The arsonists are buying fire extinguishers. Now look, when I say that, I'm not saying this gleefully. I'm saying it as someone who's been watching this trend unfold for over 30 years. When you see central banks in Asia, the Middle East, and even South America all moving in the same direction, reducing dollar exposure, increasing gold holdings, and building vaulting infrastructure, you know this isn't temporary. And this trend is accelerating. When we talk about these multi-jurisdictional gold vaults being built across the Belt and Road network, what we're really talking about is the infrastructure of a new financial order, one where trade and settlement can be done outside the control of Washington and London. Let me tell you something. The symbolism of Saudi Arabia building a gold exchange is just as powerful as the function of it. Because this is the same Saudi Arabia that was the linchpin of the petrodollar system for 50 years. The entire dollar hegemony depended on one deal, oil for dollars. And now that's unraveling. China, Russia, India, the Gulf states, they're all quietly hedging against the end of that system. They're not announcing it. They don't need to. They're simply moving their reserves, building alternative trade routes, creating new clearinghouses, and linking it all through gold. You can ignore the headlines, but you can't ignore the math. Let's talk about something else that's been happening beneath the surface. The retail side of the market. You know, I've been in the bullion business for decades, and I've never seen dynamics quite like what we're seeing right now. Demand is extremely strong, and supply, which was plentiful just months ago, is suddenly tight. Why? Because when things were slow earlier this year, a lot of dealers, wholesalers, and even mints got complacent. They didn't re-up their inventories. Carrying metal isn't cheap. It ties up millions in capital, and the costs of shipping, storage, and insurance have all exploded. So when demand suddenly roared back, the shelves emptied fast. At Miles Franklin, we pride ourselves on staying ahead of that curve, but even we felt it. Our inventory levels drop faster than I've ever seen. It's like flipping a switch. One minute there's abundance, the next minute, scarcity. And that's the nature of this market. It turns on a dime. The U.S. Mint, and I say this with all due respect, is a model of inefficiency. They can't keep up in the best of times, and these aren't the best of times. And that's before the mainstream public even gets involved. Right now, most of the action is coming from sophisticated investors, people who've been paying attention. Institutional clients, family offices, high net worth individuals who see the writing on the wall. The average person is still distracted, still riding the magnificent 7 stocks like nothing's wrong. They're all in. The insiders are quietly heading for the exit, and the public is still buying the top. That's how it always goes. And here's what keeps me up at night. When the public finally does wake up, it won't take much to blow out the entire supply chain. Let me put it in perspective. Right now, global allocation to precious metals across all portfolios, retail and institutional combined, is about 0.5%, 0.5%. That's down from a 40-year average of around 2%. So if we simply reverted to the historical mean, not a gold rush, just normal, you'd see a 4-fold increase in demand. Now imagine if it goes to 5% or 10% or even 20% like these big CIOs are recommending. That's not a 4-fold increase. That's a 40-fold increase. Do you think the industry can handle that? Not a chance in hell. It would seize up in 24 hours. I'm not saying that to scare people. I'm saying it because I've watched it happen before. During the 2021 silver squeeze, we saw inventories vanish in 48 hours. Premiums tripled overnight. That was just retail investors. A few 100,000 people on Reddit, not major institutions. Now imagine the CIOs of Morgan Stanley, Bank of America, and Harvard's endowment all telling their clients to allocate 20% to gold. Game over. You'd have a global run on physical metal that would make 2021 look like a warm-up.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.